Hello and welcome to this week's Ferrari Financial US Market News Summary. Well, last week on Wall Street certainly started in fine shape with a good rally on the first 2 days, a broad rally as well, most sections participating including the tech and financials. And these two sectors, of course, have been the main culprits for the downtrend in the last few weeks. So it was a promising start to the week, but it didn't last. Wednesday, Thursday, Friday, the rally fizzled and quite a lot of selling took place to end the week just a little higher. It seemed that investors lost their appetite to place any big bets really before the long weekend. This weekend, of course, Monday being President's Day and the markets are closed. But of course this just pertains to the US markets, and the general world markets will still be very much open for business on Monday. And there's a little concern that the last experience on the last Monday holiday when the US markets were closed and a really quite wide-scale crash in the Far East markets as well as the European markets left Wall Street to open on Tuesday in a very sad situation. So that probably played a part in investors' thinking going into the long weekend. There wasn't much else in the way of good news this week though, and we'll have a look at the chart first to take a look at the technical picture before we discuss these. We're going to take a look at the one-year chart now for the Nasdaq Composite Index. We want to focus really on the events of the last few weeks where we've had this massive sell-off really since the beginning of the year. Really from just before Christmas we had this continual sell-off right the way down till the Nasdaq actually just above the 2,200 mark at 2,208 was the worst level before we had the pullback that we've had in the last week or so on the promise of a nice fiscal package with some tax cuts and of course the Federal Reserve stepping in with an interim interest rate cut followed by further cuts at their end of January meeting. And this very nicely pulled the market back up, as you can see here, coming back up to this line, this brown line, which is in fact the long-term 200 moving average. This is a long-term average line, and when you see that penetrated, that's always a bad sign. We're back up to it now, but we do feel that if we look at the trend line that's forming, possibly covering the peak and then across the pullback that we had just before Christmas, we're heading down at an angle of something like that. If that's the case, I'll just set that in so you can see it. There we go. Oh, one more try. There it is. Now, if we see this pullback coming back up to about, at the most, about 2,500, then we're back up to where that trend line would intersect it around about here. And that's probably the danger point where this market could turn south again and continue what would be a much more prolonged downtrend. We do think this is probably the scenario going forward into the spring and early summer, because we do feel that we've seen the head and shoulders pattern fully developed here. The right shoulder, the left shoulder here, followed by the head pattern, and then the right shoulder forming just before Christmas. Now we've had the penetration of the long-term average line, and we do think that in a classic scenario we would see a little bit more of a pullback of consolidation over the next few weeks before then the market would probably turn southwards again. So we would really classify the technical picture at the moment as one of consolidation. In fact, it looks like there seems to be a triangular consolidation pattern forming. We'll probably be able to draw this on the chart for you next week, as it seems to be really establishing itself at the moment. But a triangular pattern just simply means a period of consolidation towards the point of the triangle, which may still be some weeks away. But at that point, we do expect then a breakout either to the downside or to the upside. In our view, there's more likelihood that the breakout will be to the downside. The US housing market still remains depressed, and the ongoing mortgage and lending crisis is still weighing heavily on investors' minds. Plus, there were a couple of fairly dismal economic reports last week. The Regional Manufacturing Index dropped last month, and the University of Michigan's report on consumer sentiment had a fairly large drop as well. So there's very little on the economic front that can really pick the market up to any extent, and the Fed Reserve Chairman Ben Bernanke didn't help matters with his report to Congress, where he really had very little positive to say about the American economy, other than there will still be a slow economic growth. But of course, everybody in the administration is trying to avoid admitting that the American economy is in recession. But by all the indicators, it certainly looks that way to us. The upcoming US elections are, of course, a wild card, and we'll be watching the way the political scene unfolds in the next few months. Until next week, it's goodbye from London.